Assalamualaikum warahmatullahi wabarakatuh and hi, we are from group 13, want to present topic 5, the foreign exchange market. Firstly, let me introduce myself. My name is Nurul Syazwani binti Muhammad Rafli 258968. Okay, for this topic, we need to know what is foreign exchange. Foreign exchange is the exchange of a currency of one country for the currency of another. The second is what is foreign exchange market? Foreign exchange market is an arena through which one is able to transfer purchasing power from one country to another. From D.K. Intiman and A.L. Stonehill said that the foreign exchange market is the arena through which one is able to transfer purchasing power, provide credit for international trade transaction, and provide means for minimizing exposure to the risk of exchange rate fluctuations. The next is phases of foreign exchange market or characteristic of the foreign exchange market. For the first is no physical place and OTC, over-the-counter market, as there is no physical place where the participants meet to execute their deal. And the second is size of market. Forex market is the largest financial market with a daily turnover of over USD 2 trillion. And the third is forex exchange market, 24 hours market. The market are situated throughout the different time zone of the global in such a way that when one market is closing, the others is beginning its operational. Okay, the next is who are involved in the forex market. There are 4 participants involved in forex market, and the first is corporate, commercial bank, exchange brokers, and the fourth is central bank. Besides that, why the need for the forex market? Forex exchange market is inevitable because for the first is each and every country in the world has its own national currency, and the second is international trade and investment and related transaction. Banks and the forex market. The bank are the natural intermediary between foreign exchange supply and demand. The next is the main task of a forex exchange department is to enable its commercial and financial customers to convert assets held in one currency into funds of another currency. This conversion can take form of spot transaction and forward transaction in their operation. The banks are also engaged in proprietary trading of the various foreign currency for profit. Foreign exchange rate can be expressed either as direct quotation and indirect quotation. Direct quotation based on price quotation. Indirect quotation based on volume quotation. Direct quotations, a rate expressed such that the foreign currency is the commodity currency and the local currency is the reference currency. For indirect quotation, a rate expressed such that the foreign currency is the reference currency and the local currency is commodity currency. Okay, that's all from me. Thank you. I will pass the presentation for the next presenter.
Hi, Assalamualaikum warahmatullahi wabarakatuh to our dear lecturer, Sir Syahri bin Syafi'i, and all my fellow friends. So my name is Nur Ada binti Muhammad Zain. My metric number is 258971, 258971. I will proceed the presentation with the topic of global foreign exchange. Okay, global OTC foreign exchange instrument, we can see the PACE global over-the-counter foreign exchange instrument refer to spot transaction, outright forex, foreign exchange swaps, currency option, or other products. So spot transaction is the exchange rate code for transaction that are required delivery within 2 days. So outright or forward transaction is involved in the exchange of the currency on a future date beyond 2 business days. The rate at which transaction is settled is known as a forward rate. So the forward transaction will be settled at a forward rate no matter what the actual spot rate it is at the time of the settlement. So what is a foreign exchange swap? Foreign exchange swap is simultaneous spot and forward transaction. Currency option are the right but not the obligation to trade a foreign currency. This is the most popular for foreign market uh, globally. You can see the AUD, USD, AUR have been traded, and then you can see in the URL about the current the actual currency live here at the website. So the size, composition, and location of the foreign exchange market trading in a foreign market reached a daily turnover of $6.6 trillion in April 2019. So the US dollar retained its dominant currency status, being on one side buy or selling of 88% of all trades. Why do you think USD is widely traded? So the reason why the US dollar is widely traded is because of first, investment currency in the capital market, reserve currency held by many central banks, transaction currency in many international commodity market, invoice currency in many contract, and it is lastly an intervention currency employed by the monetary authorized in the market operations to influence their own exchange rate. The foreign exchange trading process when goods or service are exported to the company so the company will receive the foreign currency against the trade. This foreign currency needs to be converted into the domestic currency. The vice versa of the above described, the procedure will happen when the goods or service are imported. So the bank provide the service for arrangement of payment in the international trade. Other reason deal in the foreign currency is because of speculation, is the buying and selling of commodity or currency that has a risk as well yet chance of profit too. So the company deal in a foreign currency for profit. This is hold true for the banks that have their own treasury department for making a profit. Other profit seeking activity is arbitrage, that is buying and selling currency at the profit due to the price discrepancies in a different market. Arbitrage is hard to practice because the transparent exchange rate globally. So that's all from me. Thank you. I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh, and hi to Sir Shahril and everyone that are watching this video. My name is Khadijah bint Abdullah and my matric number is 258991. Okay, now I will continue presenting about foreign exchange control regulation. Okay, first, let me tell you a little bit what is exchange control. Exchange control is a complete or a partial regulation by the government, which it is covering payments from one monetary area into all others, or the disposition of foreign exchange receipts and also incomes of the resident of the monetary area concerned. Next, we will take a look of why it is need for exchange control. It is because it is adopted by the government to conserve the foreign exchange resources of the country. It is not only that, but as well as to control exchange rates through the limitation of the freedom or monopolization of foreign exchange transactions, which means that it will be used to restore the balance of payment equilibrium by allowing the imports only when they are necessary in the interest of the country, and thus limiting the demands for foreign exchange up to the available resources. Okay, next we move to the need and scope for foreign exchange control regulation. There is some advantage of covering not only for merchandise transactions as already stated in the need for exchange control, but likewise the invisible items of the balance of payments. Next, we move to the objectives of exchange control, which there are 4 objectives as been stated here. The first objective of exchange control is to maintain the exchange rate and to avoid the flight of capital. The second one is to stimulate the production of certain goods that deem vital to the economy. And the third objective of exchange control is to assure imports of items considered essential to the country's well-being. Lastly, the objective for exchange control is to discourage the production of certain goods. Okay, now I will go into the foreign exchange control regulation in Malaysia. Foreign exchange control, which is FEC in Malaysia, is governed by the Exchange Control Act in 1953. The controller of foreign exchange is the Governor of Bank Negara Malaysia, which is BNM, who also acts as the foreign exchange dealings regulator in Malaysia. The bank is committed into ensuring the foreign exchange administration on FEA rules continue to support and enhance the competitiveness of the economy, which is through the creation of a more supportive and facilitative environment for trade, business, and also investment activities. The Act imposes general restriction on foreign exchange dealings by residents and non-residents. There is no restriction for non-residents to invest in Malaysia to purchase ringgit assets such as land property and securities. There is also no restrictions for non-residents to transfer abroad in foreign currency. All profits, returns, and divestment proceeds from their investment in Malaysia. The controller then publishes exchange control notices of Malaysia, which is known as ECMS, from time to time, pursuant to the which permissions they are general and specific, and the rules and parameters under which they apply and prescribe. So now we will go to the measures implemented in foreign exchange control regulation in Malaysia. The first one is in terms of increasing the aggregate amount of domestic facilities that can be extended by residents to non-residents controlled companies to 50 million from 10 million. The second one is liberalizing payments for ringgit assets between residents and non-residents, as well as between non-residents to be made either in ringgit or foreign currency. Prior to the liberalization, such payments were allowed only in ringgit Malaysia. The third one is increasing the maximum overnight limit on foreign currency accounts for exports proceeds maintained by resident exporters from USD 10 million to USD 70 million. The fourth one is allowing residents to enter into foreign exchange forward contracts with an authorized dealer to sell foreign currency receivables for ringgit for any purpose. And the last one measures implemented is removing the limit of 10 million ringgit equivalents in foreign currency for investment abroad by residents under the employee share option for purchase scheme. Next, I will move to the major exchange control regulations in Malaysia. The first one is the current account transactions. The regulation is made based on the payments of goods and services, export proceeds, import and export of currency by travelers. The second one is capital account transactions that consists with regulations of foreign direct investment, which is FDI, investment abroad by residents, foreign currency credit facilities, and ringgit credit facilities from non-residents. The third one is ringgit credit facilities to non-resident controlled companies that are operating in Malaysia up to an aggregate limit of 50 million ringgit. The fourth one is the issuance of ringgit private debt securities that residents are generally permitted to raise domestic credit facility through the issuance of the ringgit private debt securities regardless of any amounts. Next is foreign currency accounts of residents that resident exporters are permitted to open foreign currency accounts with designated banks to retain foreign currency export. Next is foreign currency accounts of non-residents, where commercial banks and merchant banks are freely allowed to open foreign currency accounts for non-residents. As for the external accounts of non-residents, is where financial institutions are allowed to open accounts in ringgit known as external accounts for non-residents. And the last one is the special status granted to selected companies that consist with offshore entities in the Labuan International Offshore Financial, Center Multimedia Super Corridor companies, and also approved operational headquarters. I think that's all from me. My friend will continue for the next presentation. Thank you.
Hi, Assalamualaikum. My name is Runisha Tasha binti Kasim, 258959. Today I will present on the practice in Malaysia Forex Exchange Market. So, back in 12 June 1967, the currency of Malaysia was known as Malaysia Dollar and issued by Bank Negara Malaysia or BNM. By that time, UK Pound Sterling was the official currency in Malaysia Forex Exchange Market. However, on 23 June 1972, UK Pound Sterling was floated. It caused Malaysia government decide to revalue the Malaysia dollar. Then Malaysia authority decide to change the official currency to US instead of UK. During August 1975, the Malaysia currency was legally renamed from Malaysia dollar to ringgit according to the Malaysia Currency Ringgit Act 1975. However, even though the names of ringgit was officially accepted, the currency of Malaysia was still referred to a dollar. This scene was being continued until year 1993 when the currency of Ringgit Malaysia was introduced to replace Malaysia dollars. In 2012, Bank Negara Malaysia stated that forex trading or the selling and buying of foreign currency in Malaysia is allowed only through licensing commercial bank, Islamic Bank, Investment Bank and International Islamic Bank. However, there are three acts related to Malaysia Foreign Exchange Market. So the first one is the Exchange Control Act of 1953. This act imposed general restrictions on foreign exchange dealing by resident and non-resident. However, there are no restrictions for non-resident to invest in Malaysia to purchase ringgit assets such as land property and security. On top of that, there is also no restriction for non-residents to transfer foreign currency or profit, returns and reinvestment proceed from their investment in Malaysia abroad. Second one is Security Commission Act of 1993. This act gives power to the commercial security to license and regulate business dealing in security. The last one is the Money Changing Act of 1993. This act provides the licensing and regulation of money changing business. For example, under this act, a person licensed under the Exchange Control Act 1953 is permitted to trade foreign currency that is licensed under the Money Changing Act 1998. Bank Negara Malaysia has further refinement the forex exchange policy in order to improve business efficiency and provide flexibility for corporate to better manage their foreign exchange. There are four refinements of foreign exchange policy, which are: first, residents exporter can retain 100% of export proceed up to 200,000 equivalent per transaction in foreign currency in their trade foreign currency account. Previously, exporters were allowed to retain up to 25% of export proceed in foreign currency and convert the balance into ringgit. This flexibility is administrative burden for exporters, especially SME, to meet their foreign currency obligation. Second, residents can hedge foreign currency loan obligation up to underlying tenors. Previously, hedging of foreign currency loan obligation is up to 12 months only. This flexibility enabled residents to better manage their foreign risk arise from long-term foreign currency loan exposed. Third, resident and non-resident are free to change or unwind their hedging except hedge on portfolio investment in response to changing market condition. Previously, resident and non-resident need to seek the bank approval to unwind hedging position, while those registration under the corporate hedging framework can unwind their position in line with their underlying business need. This flexibility allows all entities to unwind their forward position and manage their hedging costs except for portfolio investment in response to changing market conditions. The fourth one is residents can freely obtain financial guarantee from non-residents, example, parent company. Previously, residents can only obtain financial guarantee up to an aggregate limit of 100 million. The limit removal would enable foreign investors to better support their entities' operation in Malaysia. Last one, residents can freely issue financial guarantee to non-resident, example, subsidiary abroad. Previously, residents can only issue financial guarantee up to an aggregate limit of 50 million. This flexibility remove the limit with the exception mentioned, thereby enhancing Malaysia firm able to support their global operational. So that's all for me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh and salam sejahtera. My name is Sadatul Saadah binti Razaman, matrix number 258992. So next, I will present about the foreign exchange risk transaction. There have two types of foreign exchange, which is exposure and also the risk. So foreign exchange exposure, it is defined as the extent to which the transaction assets and liability of an enterprise are denominated in currency other than the reporting currency of the enterprise itself. The reporting currency is normally the national currency of the parent company. Exposure arises because the enterprise denominates transaction in a foreign currency or it operates in a foreign market. Foreign exchange risk is defined as the net potential gains or losses which can arise from exchange rate changes to the foreign exchange exposure of an enterprise. It is possible that an adverse exchange rate movement may turn an otherwise profitability due into a loss. It is also possible that an unexpected movement in the exchange rate is favorable and one fall profits. Foreign exchange risk arises when a company engages in financial transaction denominated in a currency other than the currency where that company is based. Any appreciation or depreciation of the base currency or the depreciation or appreciation of the denominated currency will affect the cash flows emanating from the transaction. Foreign exchange risk can also affect investors who trade in international markets and business engaged in the import or export of products or services to multiple countries. And then the process of a closed trade, whether it's a profit or loss, will be denominated in the foreign currency and will need to be converted back to investor-based currency. Fluctuation in the exchange rate could adversely affect the conversion, resulting in a lower than expected amount. An import or export business exposes itself to foreign exchange risk by having accounts payable and receivable affected by currency exchange rates. This risk originates when a contract between two parties specifies exact prices for goods or services as well as delivery dates. If a currency value fluctuates between when the contract is signed and the delivery date, it could cause a loss for one of the parties. There have three types of foreign exchange risk, which is transaction risk, translation risk, and economy risk. Many firms are exposed to foreign exchange risk, that is, their wealth is affected by movement in exchange rates and will seek to manage their risk exposure. There are different types of foreign exchange risk. What is transaction risk, translation risk, and economy risk? So, transaction risk is the type of risk is primarily associated with the import and export. If a company exports goods on credit, then it has a figure for debtor in its account. The amount will finally receive depends on the foreign exchange movement from the transaction date to the settlement date. For the translation risk, the financial statements of overseas subsidiaries are usually translated into the home currency in order that they can be consolidated into the group's financial statements. It is the translation, not the conversion of real money from one currency to another. For economic risk, is a transaction exposure focused on relatively short-term cash flows effect. Economic exposure compasses this plus the longer term effect the changes in exchange rates on the market value of a company. Basically, this means a change in the present value of the future after tax cash flows due to changes in exchange rates. So next, how to manage foreign exchange risk. The most common way to manage transaction exchange rate risk is hedging strategies. In hedging, each transaction can be evaded by the methods of forwards, futures, options, and other financial instruments. Hedging strategy is generally employed to lock in a future exchange rate, at which the foreign currency can buy or sell, leaving the company immune to volatility in the exchange rate market. Since the future rate is locked at the outset, the exchange rate movement will not result in losses. However, there is a downside too for hedging a transaction. Though it prevents the losses, it can also cut down profits of the transaction in case of favorable currency movement, as the exchange rate is locked at the initiation of the transaction. The second exchange risk is translation risk or balance sheet risk is difficult to hedge or control. It involves balance sheet items such as long-term assets and liabilities which are difficult to hedge due to their long-term nature, and this risk is hedged very occasionally. The third risk is economic risk. It's also challenging to hedge as it is complicated to quantify the risk and then hedge it. Economic risk is the residual risk and is often hedged at last and in many cases left it in unhedged. That's all from us. Thank you.